Quantitative easing is inflationary.
The Bank of England's Monetary Policy Committee has been purchasing assets financed by new money that the bank creates electronically. Often known as quantitative easing, this policy is designed to inject money directly into the economy. This is in response to a sharp fall in demand as businesses and consumers reduce their spending. In short, there's not enough money in the economy. The aim is to boost spending to keep inflation on track to meet the 2% target. Alongside its decisions on asset purchases, the Monetary Policy Committee continues to set bank rates each month. The bank purchases assets from private sector businesses, including insurance companies, pension funds, high street banks, and non-financial firms. Most of the assets purchased are government bonds. There's a large market available, so the bank can buy substantial quantities of assets fairly quickly. The Bank of England's injection of money into the economy works through different channels and has a variety of potential effects. When the bank buys assets, this increases their price and so reduces their yield. That means the return on those assets falls. This encourages the sellers of assets to use the money they receive from the bank to switch into other financial assets, like company shares and bonds. As purchases of these other assets start to increase, their prices rise, which pushes down on yields generally. Lower yields reduce the cost of borrowing for businesses and households. This, in turn, leads to higher consumer spending and more investment. Of course, higher asset prices also make some people better off, which provides an extra boost to spending on goods and services. The Bank of England is also buying smaller amounts of private debt, like corporate bonds. These purchases are aimed at improving conditions in capital markets, making it easier for companies to raise money, which they can invest in their business. There's another way the bank's purchases of assets could put more money into the economy. Those selling assets to the Bank of England deposit more money into their bank accounts. So commercial banks have more funds which they can use to finance new loans. And more bank lending supports spending and investment. But this channel is likely to be relatively weak as banks continue to repair their finances in the wake of the crisis. That's why the Bank of England is buying most of the assets from firms other than banks. The extra money the Bank of England is injecting into the economy should increase spending to help keep inflation on track to meet the government's 2% target. Without that boost, the amount of money in the economy would be too low. Spending would be weaker and inflation might fall below target. But as perceptions of an improvement in the economy begin to spread, this will stimulate business and consumer confidence. That will help to underpin expectations the policy is beginning to work, which should itself encourage more spending and keep inflation in line with the target. As it sets policy each month, the Monetary Policy Committee will continue to be guided by the outlook for inflation relative to the 2% target. If the committee thinks inflation looks set to rise above target, it could raise bank rate and sell assets to remove the extra money it has put into the economy.
And coming in from the Bank of England's own website, how does quantitative easing work? QE acts in a similar way to cuts in bank rate. It lowers the interest rates on savings and loans, and that stimulates spending in the economy. The lower interest rate on UK government and corporate bonds then feeds through to lower interest rates on loans for households and businesses. So it really is all about driving down interest rates. So people don't save, that people actually go and borrow and spend in the economy. Consumerism, consume literally means to destroy. So instead of saving, instead of investing, by the way, lower interest rates actually show that it doesn't, in fact, increase investment in the business sector. What it does do is creates an enormous amount of debt into speculative assets, whether that's stocks, bonds, or real estate. So what we'll do now is we'll cut to a clip with the guy who coined the term quantitative easing, Professor Richard Werner.
We can get out of any crisis without using taxpayers' money and without reducing public welfare spending as a result and austerity, because we can just use the reality of bank accounting to get cleanly out of any banking crisis. And this is also what central banks have done in the past when they didn't want a banking crisis to turn into a major recession. They just solved the problem like this. You can do it in one morning and you will not have a real banking crisis and you will not have a recession. This is what Ben Bernanke did in 2008. And he was actually, I proposed all these things in the 90s in Japan in these big debates we had where I also proposed quantitative easing. And Bernanke was joining these debates. And he was in 2008 the only central banker to implement my advice, the true quantitative easing, because the others slightly changed the definition. Step one, you have a bust banking system. The capital and the Basel approach is not enough. It's this tiny amount anyway. And when the banks create money, use it for financial transactions, push up asset prices by 300-400%, which is due to banks creating this money for financial transactions. At the peak, if then asset prices drop by 10%, you've used up all the equity for the non-performing loans already. You're bust. So that's why we have the banking crises. So how do you get out of this quickly at no cost to the taxpayer? It's very simple. The central bank steps in, goes to the banks and says, oh, you've got non-performing assets larger than your equity, you're bust, all of you, bust banking system, always the same story. No problem, because we don't want a banking crisis now turning into a big recession. We will let you off this time. We will put in place measures to prevent this in the future. We'll talk about what those are, but we'll get you out of this one now. And you don't use tax money. That's expensive. That increases national debt. Ireland was a fiscal poster boy, but because the ECB forced it to fiscalize all the banking non-performing assets, Ireland became bankrupt, had to call in the IMF. No, we don't do that. The central bank steps in, goes to the banks and purchases the non-performing assets at face value. And the problem is solved. There's no cost. And this is exactly what Bernanke did. That's why in September, October 2008, the balance sheet of the Federal Reserve quadrupled in 1 month. This doesn't create inflation. Some people thought at the time, wow, we're going to get hyperinflation now. They're inflating their way out. No. If you want to create inflation, some countries try to do this allegedly, like Japan for 20 years. It's not going to work with this method because it doesn't create money, because you're just shifting assets between the central bank and the banks in the right way, away from the bank balance sheets where they are harmful to the central bank, where they can't do any harm. But you don't inject money into the non-banking sector, so you can't create inflation. Oh, but hang on, the dollar is going to collapse. Well, no, as I said at the time, and it's strengthened. Why? Because you're not creating money, you're solving the problem in the banking system. The banks are healthy again, have strong balance sheets, and can lend again. And they did in America. It's the first country to get out of the crisis. Since then, very strong bank credit growth. Unfortunately, too much. That's why we're back in the same spot. They continue to create credit for financial transactions. That's how you prevent getting into this situation in the first place of banks being unstable. Because banks create money, you have to split the stream of credit creation from banks into two, for the real economy and for financial transactions, because they're not part of the real economy. And if banks create credit for financial transactions, you are creating an asset bubble, which is always unsustainable and will always lead to a banking crisis ultimately, if it's large enough. So in the early 2000s, I was warning that in Europe, the ECB, which is newly created, was going to create bank credit-driven asset bubbles, banking crises, unemployment, large recessions in the Eurozone. And that's exactly what they did in Ireland, Portugal, Spain, and Greece, based on 30% credit growth for how many years? 3-4 years. Way ahead of GDP growth. This is all credit creation by banks for asset transactions, property, real estate. That's how you blow up these countries, and that's what the ECB did.
So Professor Werner, who coined the term quantitative easing, argued in the 1990s basically to do an asset swap between the central bank and the commercial banks with their non-performing assets. So just a bank asset swap which he argues isn't inflationary. Now, we've all believed this since quantitative easing really came about during the GFC, that all the central bank does is print bank reserves, and it's basically an asset swap. However, a key thing that Professor Werner said in that video was the difference between the central bank purchasing assets between the bank and non-bank sector. And that's what's different about the last couple of years. And one thing I've argued, one big reason why I say that we're going to get inflation and CPI increases is you had governments doing big fiscal spending, and that was predominantly monetized by the central banks, using the commercial banks, the dealer banks, as a shell game. Ultimately, newly created currency was being created by central banks, through into the TGA, spent into the real economy by governments. But you need to break up between banks. Now, he argued that we're going to see asset price inflation, and guess what? He was right, because it was quantitative easing purchasing assets into the financial system, into the banking system, not the non-bank sector. Now, I've done a couple of videos with Professor Werner. So obviously, he argues that his definition of quantitative easing and what Bernanke initially did wasn't going to be inflationary in the real economy in terms of CPI. However, he's changed his tune in the last 2 years. And I've done this video, 2023 Currency Collapse by Gold and Silver, where Professor Werner was arguing about hyperinflation, high inflation and hyperinflation. Now, I also did this video where Professor Werner, he and I actually had a exchange on Twitter about this, and this is where he first, and this made news, where this was the first time he came out and talked about hyperinflation 2023, was a reply to or an exchange that I had with him, and that then made the news. So things are different now. Now, what I'm going to do, if you like this video, please hit that like button, and also put your love to see your thoughts and opinions in the comments below. Now, what I'm going to do is cut to a couple of clips with a former New York Fed trader, Joseph Wang, aka Fed guy, and a video from with Russell Napier. So, and basically what they argue is bank reserves money? Is it cash? Is it, yeah. Anyway, this will be quite interesting.
Russell, you had a disinflationary view for the past decade, and recently you've changed. It's quite remarkable, to what degree you've changed your mind. You don't change your mind often, but when you do, and you see the facts change, you really make a pivot. The quantitative easing, the explosion in bank reserves, that from 2010 to, let's say, early 2020, before the pandemic, did not cause inflation, despite the fact that so many people thought it would. Why do you think that the huge increase in money supply this time in terms of bank reserves is going to make it into the economy?
Yeah, so it's different types of money, which is the key thing. So bank reserves are an asset of the commercial banking system. They are, if you like, the liquidity of the commercial banking system. If you and I were bankers, it's kind of the money we have on hand to pay back our depositors. It's not in the form of cash, but it can be turned to cash instantly. If we suddenly get a lot of it, the question is, what do we do with it? And if we kind of sit on it, not a lot happens in the real economy. And that is exactly what was happening with that money from 2009 to 2019. It was affecting the asset markets because the Fed was buying assets from savings institutions, bonds, and accrediting them with new money. And of course, what does a savings institution do with new money? It buys more assets. So this money sort of stuck in that ghetto. But the money that was credited to the savings institutions was a thing called bank reserves, and they were really kind of unused. So the only thing that's different is that the banks are now expanding their balance sheets, and quite aggressively. And that creates a different form of money. I mean, people who borrow money from banks tend to use it in the real economy. They can, of course, just use it to buy assets, but on the whole, it tends to get used in the real economy, and that's broad money. And the history of that money is that is the inflationary form of money, because it affects nominal GDP, it affects final demand. And as I said, it's up 43% over 2 years.
I'm really glad you brought up bank lending. A lot of critics critics of quantitative easing, or just people who comment on monetary policy, note that quantitative easing is not that inflationary, or in fact inflationary at all. Some people even go say it's deflationary, and that the true engine of inflation, hold your critique. Let me say the true engine of economic growth and inflation is bank lending. On our previous show last Friday, you said that bank deposits aren't really money, but treasuries are money, and bank reserves, Federal Reserve bank reserves, which are liabilities for the Fed and assets for commercial banks, that is real money. Because if you're Bank of America, you have $1 billion in bank reserves, you can call the Fed and say, I need $1 billion in cash. Can we just, we've received so many questions about your view on that. So this is a question from Byron, the writer of our newsletter at Blockworks, former equity trader, really smart guy. I recommend that everyone subscribe to the Blockworks newsletter. We can put a link in the description. Byron asks, and by the way, Byron, huge fan of your work, Joseph. He says, Joseph says bank reserves are money because banks can have them delivered as physical cash money, but they only do that to fill ATM machines and stuff, right? So saying bank reserves are money is kind of a semantic.
I get this question a lot, whether or not reserves are money, and for me, it's a very surprising question, because if you're at the Fed, or if you're in a big commercial bank, I mean, it's not even something you think about. Well, I mean, where do dollars come from? What's the purest form of dollars? It's printed by the government, right? So by the Federal Reserve. Bank reserves are just digital cash. If a bank, let's say, wants to buy treasuries, well, they can just settle that payment with reserves. If they wanted to have cash on hand, they could swap that for currency. I don't really understand why that people don't think that of as money. It's very much just the CBDC. It's the original CBDC. It's just that you have to be a bank to hold
a bank.
Yeah.
Yeah. I think the term, it's money, it's easy, these are very judgmental semantic words. But is it inflationary?
Yeah. I think I think you're right. I think that's what people think about a lot. So they see that the reserve levels are very high. So maybe the Fed created a lot of reserves. Why is it inflationary? Well, the thing is that a bank is not a consumer like you and I. A bank, it just can't go out and buy a whole bunch of cars and stuff like that. Banks have a lot of regulation that constrain what they can buy and what they can sell. So when the bank has a lot of money, what it goes and does these days is that it goes and buys treasury securities or agency MBS, and that's what you see them do to the tune of 1.5 trillion over the past couple of years. So they're not going out and buying the stuff that we buy, computers, cars, CDs, food, or something like that. They buy what banks buy, safe assets. And so you see tremendous, I guess, inflation in safe assets. You're seeing, let's say, treasury yields are, let's say, 1.8, 1.7, but inflation is 5-6%, right? So part of the reason is because banks have a lot of reserves, and things that banks buy, their prices go higher.
So reserves, I'm so glad you brought that up, because cash, you said banks have so much cash, the cash is being removed. Should we say it's not dollar bills, it's not $100 bills, it's not even bank deposits, what we think of money when we see electronic money, which are assets for us, but liabilities for banks. I know, Joseph, that the term cash might trigger a few people in the comments saying, Joseph, you worked at the Fed. You of all people should know that quantitative easing, bank reserves, are not cash. Explain yourself.
Bank reserves are digital cash. It's basically a CBDC. If you're a bank and you have $100 in reserves, you call up the Fed and they'll swap in for $100 in currency. Bank reserves are cash held by banks. They are what you hold in your bank. That's not cash. That's a bank deposit. That's an IOU. So when the Fed does QE, it's increasing the level of reserves in the system. Yes, the level of cash banks hold, but because, like you mentioned, you and I, we don't have accounts at the Fed. So if I sell something to the Fed pays my bank, and my bank basically just credits my account, increases the level of deposits in the system and the level of bank reserves. So now we're going to reverse that. Usually that's not good for risk assets, because what happens is that when you have a lot of bank deposits in the system, people go and they kind of rebalance. So let's say that I need a little bit of yield. Let's say that I need a risk-free asset. I can't hold bank deposits. So yeah, I have to go buy something like Apple stock or maybe higher duration treasuries.
Here's my question: what can banks do with reserves? Can they buy treasuries with them? Can they lend them out? Like you can't really convert reserves to deposits, right? You sort of create deposit out of thin air. Like the central reserves. There's no way that I, as an individual non-bank, could touch a reserve, right?
Right. So reserves are CBDC, right? You have to have a wallet at the Fed to hold them, right? So banks have wallets so they can hold reserves, and they can always convert the reserves into currency. That's where currency comes from. You go to your bank and you ask for currency, right? Where does the bank get the currency? Well, they call the Fed and they swap their reserves for currency. That's where the currency comes from in the ATM. So reserves are very much, money. It's digital. They're literally digital dollars.
Okay. Cool. And then when banks, the sclerotic loan growth that we've seen over the past 10 years, banks have had tons of cash. How come that cash hasn't been flowing out to citizens?
Yeah, so banks create cash. They're not really constrained by the level of reserves. It's really more about regulation and loan demand, profitability, things like that. But so I watched the bank earnings for the last week for JPM and Bank of America, and they're saying very positive things about the economy and loan demand. So Bank of America and GPM are both saying that there's more loan demand. They're making more loans. Bank of America is looking at the cash balances of people who bank with them, and they're seeing higher checking account balances. So this is really important because, if you have more money in the system, you have more demand. Money is purchasing power. It's demand. So you're going to have more, at least in a nominal sense, nominal economic growth. So what we're hearing from the banks suggests that we do have a strong economy, that things are going well.
So is quantitative easing inflationary? Well, I'll let you guys be the judge of that. But I wanted to finish this video with a tweet from Chris McIntosh from Capitalist Exploits. He says, if you're worried about liquidity, buy dollars. If you're worried about solvency, buy gold. I anticipate we'll need both at different weightings going forward. And then Brent Johnson from Santiago Capital retweeted it and said, I could not have said this any better. Dollars and gold, the two most important assets to own. Anyway, guys, if you like this video, please hit that like button. Love to see your thoughts and opinions in the comments below. Take care, and I'll see you all again on another episode of Finance Uncut.